They did change the way retail is done. It's incredible. It is very difficult to keep buying as it goes down 95%. Oh, that's hard. 10 times increase in their profit. Wow. Amazon stock, it is just an interesting company to me. I thought Amazon was overpriced a long time ago, and since then it's up almost like 8 times. So guys, one thing I want you guys to remember about Amazon stock, to go back in history. Let's pull it up in our software and I'm gonna show you. You look at Amazon stock in our software, you sit there and see a lot of growth here. But what you don't realize is back here, it was at 113 a share. They had a lot of splits since then and fell to 6. But you don't see that here. That's why it's very important to stick to the fundamentals of the business. And when the stock falls, to reevaluate at all times. And if the stock still has the fundamentals intact and your thesis is still in play, it is very difficult to keep buying as it goes down 95%. I get that. And I'm not saying it was worth it anywhere along this line. But the point is, this is just evidence that you don't see 95% drop here. But that's what happens when we have massive growth, right? So that's the key here. Now, when you look at Amazon, 52-week high of 170, all-time high of 188 back in July of 2021. And its recent 52-week low was $81. So over a 50% drop. Now, Amazon was a company that everybody thought, oh my God, this company does everything. It's incredible. Well, here's my issue with Amazon. Their gross margin is 12.9%. That means for every dollar they bring in revenue, only 13 cents goes to them before paying for overhead. After all taxes and overhead and everything, in the last 5 years, they've averaged 4.2, and last year was 2.3%. Their margins aren't big. And right now, they're only making money off AWS, their high margin server business. And that high margin's like 80 or 90%, and that's already factored in this gross margin. They don't make money right now selling products. It might be temporary. But I read an article back in October, November, where Amazon said, our goal is to do $150 billion in revenue in the final quarter of the year and break even. Oh, that's hard. I don't deny that Amazon's an amazing potential business, and Jeff Bezos has done a great job. But at some point, I got to ask the question, how am I getting my money as an investor? Every investment's the present value of all future cash flow. Their average 5-year cash flow is $5.9 billion. Last year, they lost $26 billion in cash flow because they really spent a lot of money on expanding and warehousing and things like that. So I'm okay with that. But they're a $900 billion company. They used to be $2 trillion, generating $6 billion over the last 5 years per year. Even if it was $60 billion, it's still 15 times. So what's it going to take for them to make $60 billion a year in free cash flow? I don't know. Let's go to their 8 pillars here. Guys, it's tough. And again, you shouldn't buy or not buy a company just based on its 8 pillars. It's a way of screening. It's a way of telling a story. That's why we use the 8 pillars. So if you're new to the channel and you're hearing about the 8 pillars, all it is my way of saying, here's what I look at a company real quick to decide if I'm interested or not. This tells me right now there's a lot of things I have to work on. There's a high PE, a high price of free cash flow. I'm not worried about the number of shares. I mean, it's only 4% more shares. ROIC is pretty close. I think there's a lot. I don't think this tells the right picture. I think the company's a lot better than this picture tells, right? That's hard because I look at this going, well, they also spent $60 billion in the last year on growth. It cuts this down. I mean, there's a lot of explanations to all of this. When your cash flow is low, your debt looks higher. There's so many other things. So I have to go look at the income statement here. Man, look at this growth, guys. 10 years ago, 70, 85, 100, 130, 160, 220, 265, 347, 457, $500 billion in revenue. That's incredible. Now let's go look at the profit here. Pennies, 2 billion, 2 billion, 9, 11, 17, 26, 11. Okay, it's getting better. Let's go look at their free cash flow. This is what I was talking about. Look at these big jumps in capital expenditures. Free cash flow is cash from your operations less your capital expenditures, okay? When capital expenditures are high, you have to find out, are they investing in real growth potential that's going to pay off in the company? Are they doing something here that's going to drive up a lot of value and profit? That's the question here. In the last 3 years, they've done $150 billion in capital expenditures. Listen, I know you. I don't care where you are in this country. You probably know an Amazon facility or several of them have gone up around you. They're insane how great they are. I mean, same day ordering on lots of things. I can literally be 8 o'clock in the morning, realize I ran out of deodorant and order it. It's at my doorstep by 3 o'clock. That's incredible. They did change the way retail is done. But remember, there's a lot of cost to these. Yes, they're not brick and mortar, but they have a lot of warehouses. That's brick and mortar. That's a lot. So I guess the question becomes, what should you pay for Amazon stock? So this is our stock analyzer tool. The issue with the stock analyzer tool is You have to sit there and make a lot of assumptions, and it's hard when there's companies that have very fluctuating profits. So let's take a look at this. We're going to look at a 10-year analysis on Amazon. We're going to look at revenue, profit, free cash flow margin, PE, all these things, and we're going to input it in here. Now, obviously, the bigger and bigger a company gets, the harder it is to grow. So I can't look at this 24% per year for the last 10 years of revenue growth. I have to assume a lot lower. So let's go to the analyst estimates on our software to see where they currently stand on that. Wow. So analysts, a lot of analysts here are expecting a massive increase in their profit. 10 times increase in their profit. Is that true? I don't know. They are spending a lot today and sacrificing today's profit. So that's not unreasonable, I guess. I just don't know if that's accurate. And look at everybody's doing a high range here. The low and high are very close to each other. All right, could be potential. Let's look at their revenue growth. Very little. So at $20 per share in profit, they currently have how many shares outstanding? 10 billion. They're factoring in $200 billion a year in profit. Wow. Wait a second. I don't like that. They're factoring in $700 billion in revenue and $200 billion in profit. How are they going to suddenly go from 3 or 4% profit margin to 30% profit margin? I call BS there. Timestamp this video. Make a note to check this out in 2026. I have a hard time believing they're going to make this money. All right, let's go to Stock Analyzer tool. Revenue growth. I'm going to go with 3, 4, 5%. 3, 4.5, 6%. Let's do that. Profit margin. I'm going to do 4, 7, and 10%. Same with free cash flow. I'm just going to assume the same over long periods of time, and hopefully their capital expenditures really decrease. PE. Guys, remember, the companies should have a high PE with a high return on invested capital, which they had a reasonable one. It wasn't anything great. They were at 8.9% and a lot of growth potential or a lot of growth potential. They don't have either one of those. So I'm going to go with the average in the market's 15. I'm going to go with 15, 16.5, and 18. God, this is so hard because that's the point. When you're using this tool, it's a great way to just say, are we even being reasonable here? Like, I'm making these assumptions. I don't know where it could land. Are we being reasonable here? My desired return, 12, 14, and 16. Guys, you can get 9 or 10% by investing in the stock market ETF. So as you get higher and higher assumptions, you need a bigger margin of safety. The higher desired return, the less you pay for the company. It's a larger margin of safety. Repeat that, rewind this, and rewatch this entire Stock Analyzer tool because this one's hard. We're making guesses on everything here, and with Amazon, it's especially hard, especially with what I saw at the analyst estimates. Analysts are expecting them to make $20 per share at 10 billion shares at $200 billion on $700 billion in revenue. That's a 30% bottom line margin when they're currently doing 3%. That's 10 times their profit margin. Their gross margin is only 13%. So in order to make 30% bottom line, you have to have at least a 50 or 60% gross margin. I just don't know how that happens. Even if 100% of their growth from here on out is all AWS. Wow, this is hard. All right, hit the analyze button. The stock's currently 89. All right, we have a low price of 25, high price of 66, a middle price of 45. So what this tells me is, and it's on my watch list at 60. This doesn't mean I'm buying it at 60. It means I'm probably interested below 50, and I'm going to start selling puts at some price below there. But don't just go off my numbers. You have to do your own research. I'm here to educate you on a process. That's the key here. So guys, if you like our software, everythingmoney.com, money back guarantee, risk-free guarantee right now. Sign up today. If 30 days from now you don't like it, before the 30 days is up, email us, money back guarantee, no questions asked. Thank you very much for your time.